Welcome to the Stock Market Palantir. Today we are going to talk about BYND, Beyond Meat Inc. Has delivered one of the most volatile and frankly chaotic trading spectacles of late 2025. We saw this distressed equity rally from roughly 50 cents to nearly $9, only to collapse back to sub-dollar levels almost immediately. It was just an unprecedented swing. The question we need to address, really, is what drove this? Was this event primarily a technical and behavioral phenomenon, driven by market microstructure, or was it the necessary and predictable consequence of a core fundamental action, the massive debt for equity dilution?
And that tension is really the whole story, isn't it? The tension between the technicals and the fundamentals. I'm going to argue that while the technical mechanics and the retail frenzy created the dizzying speed of it all, the overriding factor, the thing that determined the stock's ultimate destination, was that fundamental dilution and the worsening financial reality of the business. The fundamentals dictated where it was going to end up. The technicals just dictated how violently it got there.
And I'm going to argue that the sheer scale, the velocity, and the almost unbelievable magnitude of that volatility demands a technical explanation that, at least temporarily, completely supersedes any fundamental analysis. The structural mechanics of the market, I'm talking about the interplay between retail sentiment, options dynamics, and critical data latency. Those were the dominant forces that created a multi-billion-dollar wave of buying pressure that just overwhelmed any sense of rational valuation.
Okay, so I think it's important you lay out the primary mechanism you believe was at play there, especially with those options dynamics.
Certainly. The volatility was a textbook example of modern market mechanics colliding with distress. The catalyst was really twofold: an informational lag and then derivative amplification. The initial spike was driven by a powerful short-squeeze narrative on social platforms. And crucially, this narrative was built on flawed data. Before the debt exchange, the official float was small, right? Around 63 million shares. Retail traders, using outdated data, calculated the short interest against that old float, and they got these erroneous figures suggesting short interest was over 100%. This belief, however incorrect, became a self-fulfilling prophecy.
So the bad information provided the spark, but what was the actual fuel that got it all the way up to $8.85?
That fuel came from the options market. The sheer trading volume in calls surged. I think it was 282% on key days like October 21st. We're talking volume of 1.48 million contracts. This created what's known as a gamma squeeze. When the stock moves up that fast, it massively increases the risk for market makers who sold those call options. To mitigate their risk, they're forced into what's called delta hedging. They have to buy the underlying stock simply to stay neutral. This forced, systematic institutional buying is what drove the price to those insane highs. It was driven by technical risk management, not fundamental belief.
I see why you emphasize those technical metrics, I do. But to me, they are just secondary effects of the primary cause. The reason there was so much fuel to burn was the fundamental action the company took. That October 2025 distressed debt exchange. This action, it solved the near-term bankruptcy risk by pushing debt out to 2030, but it came at an astronomical cost to equity holders. They issued 316 million new shares, effectively quintupling the outstanding share count to nearly 400 million.
That fact is undeniable.
And that fact has to be the determinant. The rally you're describing was just a relief rally, avoiding bankruptcy, that quickly morphed into a profound liquidity trap. The inevitable collapse was simply the market correctly repricing the equity base on this massive new supply overhang. The real tragedy here is that the retail speculation, driven by that technical squeeze story, provided the exit liquidity for the former bondholders, the so-called smart money, who got that $316 million in new equity at a huge discount.
And your contention is that they used this rally to just liquidate their new positions?
Exactly. Once the lockup expired on October 16th, the distribution began. They used off-exchange venues, which I'm sure we'll get into, to liquidate their positions. And on top of all that, we can't forget the actual state of the business. The Q3 2025 results confirmed the shrinking company, a 13.3% revenue decline, and a $77.4 million asset impairment charge. So you have massive dilution married to a failing business model. That was the true price determinant.
Okay, so let's tackle the liquidity and volume then, because this is where the conflict between the technical and fundamental views is most obvious. If your argument holds that the fundamental supply was the dominant force, how do you explain the high-velocity, almost hyperactive nature of the trading? That massive supply, as you said, was physically constrained until 5 p.m. on October 16th, but the trading velocity went way beyond what a simple orderly distribution would imply.
I'd say the immediate steep collapse was, in fact, triggered by the release of those 316 million new shares. That moment marked the switch from a supply-restricted, option-driven market to one completely overwhelmed by genuine physical supply. The fundamental supply overhang became a physical reality, forcing that swift repricing.
I see why you'd think that, but let me give you a different perspective on that volume. We saw days where trading volume hit 1.2 billion and nearly 2 billion shares traded. Now, against a total outstanding share count of 400 million, even post-dilution, that's a turnover rate of 500% in a single day. That level of volume isn't conviction buying or selling driven by fundamentals. That is the clear dominance of high-frequency trading HFT and arbitrage algorithms just ping-ponging shares back and forth.
So what does that look like in practice?
It's what we call the wall of noise. HFT firms thrive on this kind of volatility. They were rapidly entering and exiting positions, capturing tiny dislocations, often just trading with each other. This algorithmic activity, driven by the extreme technical momentum, created those huge daily price swings, totally independent of the underlying asset value. It was just pure technical chaos for about 3 weeks.
That's an interesting point about the noise, though I would frame it differently. I agree, the velocity was high, but the key question is who was facilitating it and for what purpose? The structural necessity of dark pools facilitated the crash, and it served the fundamental purpose of distribution for those bondholders.
How so?
Well, we saw the off-exchange short volume ratio frequently go over 50% in November. Dark pools are, private exchanges that let institutions trade huge blocks of stock away from the public lit exchanges. This high short volume reflected institutional block trades, using these dark pools to distribute the 316 million new shares. They couldn't just dump all of that on the NSIA at once without crashing the price to zero.
So you're saying the dark pools were used to sort of soften the fundamental blow?
Precisely. They provided a mechanism to distribute that enormous supply discreetly over time, often selling right into the retail demand that the technical squeeze narrative had created. That high short volume was often just market makers processing these large discrete sales. So the dark pool mechanics weren't some independent technical driver. They were a necessary tool of fundamental distribution.
But let's turn to the psychological aspect, the efficacy of that retail sentiment. We can't deny the power of the meme stock narrative. Retail traders, okay, they were operating on incomplete data, but they successfully initiated a powerful gamma squeeze based on their collective belief. They pushed the stock to irrational highs that defied all current fundamentals. This just highlights that collective technical action, amplified by derivatives, can create massive, albeit temporary, mispricings that fundamental analysis simply cannot predict.
I'm sorry, but I just don't buy that. Let me tell you why. The tragedy of the retail sentiment is precisely that it was structurally disadvantaged from the very start.
How do you mean?
That retail capital, that wave of euphoria, it was merely the final step in the ownership transfer process. It provided market makers and, critically, the exiting bondholders with the demand and liquidity they needed to offload their 316 million new shares at inflated prices. The narrative itself was built on a foundational error, miscalculating the share count. The moment the full supply hit the market, the whole technical dynamic just exhausted itself.
But the mechanism of the gamma squeeze itself created massive demand that was divorced from valuation. When market makers sold those call options, they were selling volatility. As the stock price rose, the mathematical risk, the delta, of their position increased exponentially. To stay hedged, they had no choice but to buy the underlying stock, whether they believed in the company or not. That forced buying provided the tremendous force behind the rally.
I agree. The mechanism created powerful forced demand, but that demand was ultimately insufficient to absorb the fundamental supply shock. The rapid collapse proves the narrative was built on incomplete data and utterly failed to sustain the price against the reality of the dilution. The conspiracy theories that popped up in November, talking about algos eating up poor order entries, those arose precisely because the underlying dilution made the core short squeeze narrative impossible to maintain. When the fundamentals change the supply dynamic by 400%, the technical story just runs out of road.
I'll concede that the retail movement was exploited, no question. However, let's address the impending corporate action that really underscores the current state of affairs, the approved reverse stock split.
The reverse stock split is, in my view, the clearest fundamental indicator of failure and distress. It's not a strategic move. It is purely a defensive posture mandated by necessity, specifically NASDAQ Listing Rule 5550A2, which requires a minimum bid price of $1. After languishing in the 50 to 80 cent range post-crash, the company was forced to act.
It is a necessity, yes.
It's a profound psychological bearish admission that the stock failed to recover organically. Historically, in financially distressed companies, reverse splits just set the stage for more post-split selling pressure. Once the stock is reset to $10 or $20, it just begins its inevitable drift downward again from a new, higher perch. It screams fundamental weakness.
That's a compelling argument on the optics, I'll give you that. But have you considered the critical technical necessity behind this move? Maintaining exchange compliance is a key technical imperative for institutional holders. If BYND were to delist and move to the OTC pink sheets, many of those institutions would be forbidden from holding the stock and would become forced sellers.
That creates liquidity issues, but there's a deeper trigger there, isn't there?
Absolutely. More importantly, delisting would trigger the make-whole fundamental change provisions embedded within the new convertible notes issued in the exchange.
And for our listeners who may not be steeped in distressed debt language, what does that provision mean here?
It's essentially a tripwire. It dictates that if a massive corporate event happens, like a delisting, the company has to immediately pay back the new debt at an accelerated rate, sometimes with a premium. The company, having just avoided bankruptcy, can't possibly afford that. So the reverse split, while ugly and fundamentally depressing, is a necessary technical measure. It stabilizes the listing status to prevent a regulatory default that would trigger another existential financial crisis. It prevents a catastrophic fundamental outcome.
So we agree it's a measure of desperation mandated by regulatory structure, not growth. And the underlying business reported a Q3 revenue decline of 13.3% with that massive $77.4 million asset impairment. The fundamental engine is shrinking, even as the new supply of equity quintupled. That mathematical reality is the strongest factor.
The numbers are undeniably alarming, and they provide the context, sure, but my position remains. While the debt-for-equity swap created the precondition, the ultimate ceiling of value, the extreme, high-velocity price action, both the rally to 85 and the rapid descent, was purely a technical phenomenon. It was driven by options hedging, lag data confusing speculators, and algorithmic market structure processing an unprecedented turnover rate. The stock's immediate fate was determined by technical volatility, not quarterly earnings.
And I contend that the central truth here is the 80% dilution of the equity base and the underlying continuous fundamental deterioration. The speculative rally was a temporary distortion, a brief, profitable window for sophisticated creditors. The current sub-$1 price reflects the new, massively diluted reality, made worse by institutional distribution through dark pools. The fundamentals dictated the destination. The technicals just dictated the speed.
Well, this case study clearly underscores how modern market mechanics, HFT, leveraged derivatives, and engaged retail speculators can intersect violently with distressed corporate finance. It creates periods where information asymmetry leads to a massive wealth transfer from informed speculators to sophisticated creditors.
A profound lesson on the necessity of knowing the true share count and the ultimate implications of corporate finance decisions.
regardless of how loud the technical noise gets.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.